What's going on YouTube? In this video, we're going to go over Walmart, ticker symbol WMT. So we just, in the last two videos, we've gone over Target and also Costco. And now Walmart is last on the list here for us to analyze in this little group of stocks. So Walmart had reported their Q3 24 earnings November 16th here, beat on top and bottom lines. And with those expectations and guidance that they gave, majority of analysts here have actually revised their quarterly expectations lower. So over here in their earnings call, I found about three areas that I think were worth highlighting that could be brought to your attention here. So they've made good progress to improve their inventory position, okay? So once we get over their 10Q, we're gonna look at their inventories and see their inventories are up. But the reason they're saying that their inventories are up is because inflation drives the majority of the increase rather than the actual units. So when we hop over to the 10Q, we'll see their inventories are up quite a bit, but they're basically saying that it's not the units that are up, it's the actual cost of the inventory itself. So something to keep in mind there once we get to that. Also, while they are encouraged by their position and the confidence in their business remains high, the macro backdrop remains challenging as persistent inflation is impacting the consumer and their business. And obviously this was written probably a few days before November 15th or 16th, I should say, when their earnings was released. Obviously we're 30 days beyond that now with some more inflation reads, and potentially inflation has maybe cooled some to where they could maybe revise that statement there. But noting that in the middle of November they're still seeing persistent inflation that is obviously impacting the consumer, and overall that impacts their business also. And obviously we can see that in their inventories too. They're basically stating that inflation is the reason for higher inventories right now, higher cost of inventories. So they're still seeing some inflation issues within their business and how they run it. And for Q4, what they expect net sales to grow at about 3%. So next quarter, they're looking for about 3% growth on their overall sales. Over to their 10Q on their net income. Year over year, on the 3 months ended here, we can see this year they did $159 billion in revenue, and last year $151 billion in revenue. So very good growth on revenue there. When we come down here, we can see memberships slightly up about $20 million there. Not a big uptick in memberships here, but and Costco had similar numbers, but a little bit better. I think Costco was like 8% growth on their memberships, and this is probably more like, I don't know, 2% roughly. But overall revenues, nice year-over-year increase. Then we come down here to others as gains and losses, and because this is not in parentheses, this is a loss. So this costed the company $4.75 billion that is categorized in other and losses. So one thing I could not really find, I couldn't get a definitive answer on what this others is associated with. I figured it could potentially be associated with their acquiring subsidiaries or just their subsidiaries in general. That's costing them $4.7 billion just in the most recent quarter here. And we can see in the last 9 months, slightly less. It should be, in this range, but obviously we can see in the last 9 months, it's actually been pretty well contracted. It's not a big number, but last year we're sitting at $5.4 billion in overall, expenses in the other and losses here. So again, I think this is something to maybe dig deeper into, see if you can't find an answer to what others and losses could be, because obviously this does impact their overall net income significantly. As we can see, this quarter alone, they only made $643 million, but if you add that back in, they did a fantastic job on net income, but obviously this took away basically all of their net income. So it'd be curious to see, and last year you can see it actually put them into the negatives because of it. So whatever that others is obviously not helping out their net income currently. And maybe this is temporary, but based on history here, it doesn't look like it's that temporary. So I think that's a pretty big deal right now on the EPS and overall net income side of things, and something to potentially dig a little bit deeper into if you are interested in buying this company. Over to their assets here, we got cash and cash equivalents sitting at $12 billion. Then we come down here to their overall liabilities. They've got $43 billion in short-term total debt. I strip out accounts payable. So we're $104 million or $1 billion in total short-term liabilities, but I strip out their accounts payable, and that leaves them with $43 billion short-term debt. Obviously, minus off $12 billion of cash. That leaves you with a negative cash position of $31 billion. And then you still have to add in down here $68 billion of total long-term debt as well. So you add $68 billion into $31 billion. You're still negative about $100 billion in total debt. So for me, retail businesses, I do not like because of their balance sheets. If I had to pick between Costco, Target, and Walmart, Costco definitely has the best balance sheet of the bunch. And if I was to invest in any three of those, Costco would definitely be the company I would want to put my money into. The company also has about $85.8 billion in retained earnings. And down to our cash flows, we've got $10.6 billion in consolidated net income right here. And we get to add in depreciation. We get to add in investments, gains and losses as well. And then changes to their balance sheet. We can see inventories right here, $7.3 billion increased. So obviously they added inventories to their balance sheet, so it's going to be a deduction to their cash flows. But we can see $7.3 billion, and this time last year is $9 billion as well. So I mean, inventories are still kind of crushing their overall CFOs here. I mean, if you can reduce this, obviously inflation over time, this could likely get reduced anyway, kind of organically as inflation comes down. And as inflation comes down, maybe we'll start to see this number come down as well, and we'll start to see more money carry over to their cash from operations. But they're left with $19 billion in cash from operations here. And then we have to deduct off our $14.7 billion in capital expenditures, which leaves them with $4.3 billion in free cash flow in the last 9 months. And also, another thing that I typically don't look too deep into, but in this instance I did, we can see financing activities. Company issued more long-term debt, but paid off $4.2 billion of other long-term debt. But that's still $700 million difference what they added to their balance sheet, with the issuance of more debt. And then also, the net change in short-term borrowings, they added $9.6 billion in the last 9 months to that as well. So I think that's another thing to keep an eye on too. The company's borrowing quite a bit of money, and because of that $9.5 billion that they added in, obviously they also paid out dividends and purchased some stock as well, which is good, and purchase of non-controlling interest. So they bought ownership of other businesses or assets as well. They've been doing quite a bit of that. So that cost them $3.5 billion as well. But $9.5 billion, this is the one that wasn't offset. Like these two are kind of offset. This is normal, that's normal. Well, sort of normal, but it's it's nice to see for sure. But then you've got purchase of a non-controlling assets, also pretty good to see. But these two are less great to see. I'd rather see them not buy businesses and not buy company stock versus issuing more debt within the business. Personally, that's how I like to see it. I'd rather see them use the cash that they have available to buy back shares and to purchase more assets in the future as well. But instead, they're borrowing money to do that. So we can see $9.5 billion, and overall we can see that they added $3.4 billion to their cash position. And beginning of the period, they're at $8.8 billion. So now they're sitting at $12.3 billion. But if you take out $9.6 billion, that'd be a negative hit to their cash positions, substantially, to where they'd probably be sitting closer to $2 to $3 billion in cash position right now. So again, those are a couple red flags for me, is this, and then obviously on their income statement was that $4.75 billion that we saw categorized into the other that I'd really like to know more about. But over to our financial spreadsheet here, and if you want access to this spreadsheet, we do have many other tabs here. We got comps, calculator, discounted cash flow, and then a final valuation, which you'll see shortly. And if you want access to it, there is a link in the description down below to the Patreon that you can go to and subscribe to it. So financials on Walmart, come over here to our charts. We can see our revenue, gross profit, net income. They're growing, right? You got your revenue and gross profit both growing. Well, sort of, very slowly. And you come over here to net income. Back in 2015, we're making roughly the same net income as we were back in 2015. So in the last 8-9 years, net income hasn't really grown much. And a big contributor to that, though, is that $4.7 billion as well. If you were to take that out, you'd probably see your net income like way up here. You know, you'd be doing really good net income wise. Margins down here, 24.6%. This is in the last quarter, trailing 12 months, 24.3%. Looks like margins could be creeping back up close to that 25% range where they have historically been, but still pretty good range where they're at now. Net margins though, last quarter 0.3%, trailing 12 months 2.6%. So trailing 12 months is in line with where they've been historically. And, you know, I mean, obviously last quarter was not a very good quarter for their overall net margins. Return on invested capital sitting at about 11%, in line with historic levels. PE ratio to date, 25.88. Again, pretty well in line with where historically. Cash to debt, we've already gone over cash to debt. We already can see here on the charts that how much debt this company has compared to its cash position. And the net income to free cash flow, company in the trailing 12 months has produced more net income than free cash flow. And historically, we can see typically they do a lot more free cash flow than they do net income. And a big contributor to that is potentially their significant increase in their overall capital expenditures as well. We can see these are just exploding and costing them more and more money. Not necessarily a bad thing, but obviously something to keep an eye on as well. That you know, the more it costs to run the business, the less free cash flow you're going to have left over. So, and share discount dilution, we can see pretty much no change in shares. We're actually starting to see a slight reduction still in the share count, which is good. And a dividend, they are consistently paying out and increasing their dividend year over year. So that is good if you are a dividend investor. And to the comps, we got Costco and Target on the list. We have already gone over the comps here on the last two videos of Target and Costco. And I'll drop a link to Costco and then Target right after right now. And you can go check those out and look at the comps through that video or those two videos there. And over to our calculator spreadsheet to figure out what this thing is worth. So what we're going to do is we're going to begin with today's EPS and today's PE ratio, see what this thing is worth today. And then what we'll do is we'll plug in forward-looking numbers here that we'll grab from Seeking Alpha. We got 6.5 and 24 basically for PE there for forward-looking numbers. And so we'll plug those in after we get our today's valuation. So today, P-Range valuation gives them $88.08 per share, multiples comparison, $192.64, and a manual PE. So we got our market cap. So it'll take about 17.9 years to earn their current market cap. So that's pretty good. PE, price to book ratio 4.85, and today sitting at 4.94. So basically in line with its 5-year average. PEG ratio. This is not a growth company, so we're going to have a really high PEG ratio. You know, you're looking at 4% revenue growth rate, so we're not going to see much growth there. Grams valuation, $189.30. Our dividend discount model gives them $156.83. And to our discounted cash flow valuation. So average growth rate on the business here is 2.56. Analysts gave them 8% growth rate. And I decided to go with a kind of shoot in the middle there on the lower end at 4% growth rate on free cash flow. That gives them a DCF price per share of $149.05. And to Rule 72 here, we have three sources of an EPS growth rate for an average of 6.87. And that allows us to double our current EPS one time for 12 for a future EPS. That gives us a fair value of $41.23. Over to our summary now. Currently trading $155.53 today. Fair market value, $136.19. 30% margin safety, $95.33. Analysts have a price target of $178.83. So now let's circle back and plug in our forward-looking numbers here. So we got to grab our forward-looking EPS of 6.47 and our forward PE of 24. So basically, these aren't really going to change at all because they're just changing ever so slightly on the numbers there. So we got those two numbers plugged in there. That gives us a new P/E fair value of $94.66. Our multiples comparison then is 207.04. Our grams valuation then becomes 203.45. Our DCF will not change. Rule 72, we can adjust slightly. We can probably give them a future EPS of 13. That gives them about $44.67. And then our new fair value then forward-looking numbers is $142.62. Then our 30% margin of safety is basically $100. So pretty far off from where analysts are. Sometimes I think analysts get a little ahead. They try and pump this stock a little bit more and give out higher price targets than what the company is really worth, just to try and get retail investors to jump on board and ride the train up higher. But then they sell into the retail investors, and then you get a bad earnings report, and then analysts revise their price targets lower on this particular company, or any company really for that matter, not just this company. Or this is maybe a legitimate analyst price target that other analysts have averaged out to be at $178.83. All right, over to our stock chart here. I got 3 trend lines drawn in. We got a long-term upward trend line that the stock chart has held for many years here, all the way back to 2016. Made a bottom, and then but ever since it has touched this trend line, it has found its way much higher. And recently we hit, and since then have hit a new, kind of created a bit of a new channel here that we're looking like we're creating here. Every time we hit this area, we pull back. We hit it again recently on earnings, and then it looks like we're pulling back. I also have fibs drawn in here. Got from this high to this low down here, roughly ballpark. It's not exactly perfect, but it's in the range. And we can see, based on the fibs here, we're pulling back to about $148 per share, a fib line here. Bounced up to another fib line. So potentially what we could see, if you're a Fibonacci trader, I typically am not. I don't draw these in too often, but it's just something else that I sometimes throw in there just to see where potentially another support range could be. And I think what we're going to be seeing is more like $140-ish per share, kind of depending on how quickly it gets there, which would then give us another retest of this long-term trend line, which I think would be a fantastic buying opportunity. If it gets into that $142 range, I mean, that's what we're looking at on our current fair market value anyway. So, and I'm sure Target or Walmart is, and especially right now with how the economy is going to potentially probably get better, more likely. It seems to be the consensus that we're just going to have a soft landing and things are going to just kind of continue to get better and better and better. So if that happens, we're probably not going to see a 30% margin of safety on a very well-known company such as Walmart, but we still could see fair market values come into play on this one. And I think we could potentially see our way back down to this trend line, assuming, and right now it seems like the markets are also overbought. So it's very likely we could see this thing come back down to about $142 per share, and then probably find its way back up higher in the near future. But that is it for Walmart. If you found value in this video, drop a like, subscribe, comment, and back later with another stock analysis video.